Hello everyone and welcome back. My name is Greg Furman, market analyst here at TraderPlanet.com, and this is the Forex weekly outlook for the week of January the 30th, 2012. Excuse me. Now to get started this week, we're going to begin where we always do with the US dollar index. However, you can see that I've split the screen here using the Vantage Point long-term crossovers. Now, the first thing we're going to do is look at what's happened over the last week, and with the Federal Reserve, again, deliberately weakening the US dollar, trying to prop up equities, get everybody moving into these very, very risky assets such as the S&P, global equities, and gold and silver. These are all very risky assets. And when we see this, we can see, looking at the Swiss franc, is the crossover from Vantage Point on the US dollar index. The long-term crossover has moved to the downside, but we're getting a fairly wide gap in here between this blue line and this black line. This is telling me that we're in a trending move, but it's already somewhat overextended. When we look at the US dollar and how it's faring against the Mexican peso, we can see that it's lost ground, against the Mexican peso significantly. Now, when we look at the Japanese yen currency future, because if we're looking for a place to buy and sell dollars, we're looking for a place where potentially the dollar is not losing ground. We can see that this points us to the Japanese yen currency futures. This tells me that not only is the dollar weak, but so is the Japanese yen. That makes your dollar yen, your CAD Japan, Euro Japan, Aussie yen, some of these currencies, that makes those cross pairs very attractive. Now, when we look at the Euro FX futures contracts, we can see that the euro has also gained strength against the US dollar. Now, for the most part, that makes very, very little sense considering what's happening in the eurozone right now. So again, we want to take that with a bit of a grain of salt, to say the least. But we can see how the dollar is weak against all of the major currencies so far, except for the Japanese yen. The Canadian dollar, even, we can see here that it's even lost ground against the Canadian dollar, its North American counterpart. Now, this correlation is a different one, because it's not always one up, one down. In a lot of times, what will happen is the Canadian dollar will actually, to some degree, follow the US dollar. So this one here, you'll probably see over the next week the Canadian dollar not make the kind of gains that maybe the pound, the Aussie, the New Zealand, and the euro could possibly make. Now, when we look at the British pound, we can see that, again, this is somewhat suspect also, considering the UK economy is very, very sluggish. And so I would be a little cautious of this one also, but we can probably expect a little bit more strength from the pound. Now, the Aussie, being a risk currency and, of course, a very high yielder, this is a long Aussie US trade, still looks pretty good here because of the fact that the US dollar, the Fed has made the US dollar nothing more than a funding currency, a very cheap funding currency for these types of carry trades. So again, things are not looking great for the US dollar going into the week. But the one thing I want to point out to everybody here in this type of analysis of the Forex market going ahead is we can actually see, we're starting to see a turnaround in the US Treasuries and the Treasury bonds. Now, when we see this, this is indicative of a move up on the dollar, not down. So this is a red flag here that tells me that maybe the US dollar is not quite as weak as what the Fed is trying to make it out to be. And again, in my opinion, the situation in Europe will trump anything the Fed does, and the money flows will immediately go back into the US dollar. We certainly can't forget that. Now, we can see that whenever the US Treasury bonds have moved up, the dollar has moved up shortly thereafter. So if I were to look at this and break this down even further, we can see that basically on the medium-term crossover here on the short-term crossover on these Treasury bonds, we actually have a buy signal on short term. So now, again, that's not to say that the US dollar won't sink further if the market gets it into their head with a very bearish sentiment. But this signal alone on the US Treasury bonds is enough to be very, very cautious when getting aggressive selling US dollars, especially leading into a non-farm payroll announcement, which is what we'll be getting into next week. Now, the other thing we want to look at here is the correlation to light sweet crude oil. We can see that light sweet crude oil, we have a sell signal from Vantage vantage point. This, in my opinion, is also a potential warning sign that we may be moving higher in the dollar before too long. So again, we can see this correlation that at times they do correlate together, but for the most part, US dollar up, light sweet crude oil down. So this correlation here, this would suggest that if this were to accelerate, the dollar would get even weaker and crude oil would get stronger, but that appears extremely unlikely looking at the Fed's medium and long-term forecast. Now, the Fed can't have it both ways. He can't say that you know, the higher commodity prices are transitory and they're well contained when his very announcement sets off a rally in the commodities. So you have to see the humor in some of the things that the Federal Reserve does, and that's probably largely why so many people want to get rid of the FOMC, because they're not causing any real transparency or any stability in the market. They're actually causing the exact opposite, only in my respectful opinion, again. Now, when we look at this, when we're in a recessionary times and the global economy is somewhat slow, that's not indicative of higher oil prices. So again, we have a number of anomalies here that simply at this time of year don't make a lot of sense. Number one, the $100 a barrel in oil, the higher gold prices, along with the higher prices in equities. So it brings somewhat of a suspicious undertone to the current equity rally, and clearly that rally is Fed induced. So when we look at things, where is that going to leave us this week for the potential move in the equity markets? Now, bringing our main indicators back in line here, we can see that we're basically sitting right around a trend line here on the S&P 500. The predicted true strength indicator and the predicted MACD are heavily overbought here. Now, the predicted short, medium, and long-term differences, they do have room to extend here, which is surprising, but I would suggest that we would be getting into a corrective move at least back down to this key level of 1293 on the S&P 500, which would indirectly support a corrective move on the US dollar. Now, bringing the US dollar index back with our main indicators, the one thing we want to look at is the predicted short, medium, and long-term differences. We can see here that the long-term predicted difference from vantage point is in grossly oversold territory. Now, if I bring this out 6 months so we can look at it closer when our long-term difference has been at this level, you can see right back here, this would have been back at the essentially right around the beginning of November when the predicted long-term difference hit -1. That set off a huge rally in the US dollar index where it went from 76 all the way to 82. So again, we have to make sure that we're not leaving some of the stones unturned here and that we're looking at everything, because again, it's not always as it appears. This brings me to gold and silver. When we look at gold and silver, the only reason gold and silver have rallied is based on what the Fed has said. Prior to the Fed announcement, gold was already selling off, and then there was a huge spike of $100 an ounce strictly based on what the Fed did. We simply have no control of something like that, and it's when you see a move like that, 90% of the time it's very, very short-lived. I believe we could see a rally, a small rally in gold and silver, but I do not believe we're going to see a trend reversal where gold is going to go back to $2,000 an ounce. I think it's probably just about the exact opposite, that once the dollar begins to strengthen, and again, we're in an election year here, then gold and silver will likely turn lower as quickly as they turned higher. Remember, we've seen some wild moves in gold and silver where they've gained 10, 12%, I think as much as 15% in 1 month. So we're gaining close to that now. Now, going to some of our currency pairs, looking at the Aussie US, again, you can see what's left of this trend line that's broken up, but we're getting into overbought territory. I would be looking this week for somewhat of a retracement by midweek back down to this 104 area. Shorts still a reasonable play. I would be very cautious about getting long up at these lofty levels. The same thing applies to the New Zealand. The New Zealand's been the Kiwi's been the strongest currency in the Forex market, and again, it's very, very highly debatable why. So again, this is a risk on, risk off. they're prompting that risk is on. After everything I've said in this webinar today, there are certain signs here that risk is not necessarily on. It's on because the Fed has stated that it's on. He has put it on. So that's requires caution. The gains that the New Zealand US dollar has made is capable of giving that up just as quickly. The key level here is 80.23. The further we move away from this area, the more likely it is we're going to retrace to it. And by looking at this, we are extremely overbought here on these other additional indicators from Vantage Point. I would be looking for a significant pullback on this by midweek. This brings me to the US-Canadian pair. It's broken lower. The Canadian dollar is again a risk-based currency, but highly correlated to those crude oil contracts. The only way we're going to get below parity and stay below parity on the US-Canadian pair is if we have higher commodity prices, which means the rally in gold and silver will have to maintain itself, and more importantly, the rally in oil will have to maintain itself. Both appear very, very unlikely. When we look at the pound dollar, we look at an extremely overbought condition here, guys. I would say one more push maybe to the upside, and then this one is likely moving lower. Our key level now, 155.49, though, however, is held on multiple occasions this week. So a good call from Vantage Point there on this particular move. But again, it is based around risk, and the pound dollar is essentially the same trade as Euro US. So again, I would be very cautious on this one. And that, of course, brings me to the Euro US. You can see I have this trend line coming in that we're basically sitting on right now. Now, I have further resistance up higher, up in that 133.50 area. I would anticipate a potential move to that area. But as soon as everybody talks about getting short the dollar and long the euro, we have to remember here, guys, it was just about a week and a half, 2 weeks ago, that all the major analysts were calling for 120 euro US, and next thing you know, we're at 132. So remember what I've said on those US Treasury bonds. Keep a very close eye on them. Keep a very close eye on the US dollar index and the light sweet crude oil contracts, and try not to pay attention to everything you're hearing on the news and everything else, because it really hasn't been that accurate lately. Now, looking at the dollar yen, I think that this is going to be a very, very good medium-term trade. We had a nice rally on it pre-Fed, and then of course the Fed just killed this pair. Now, things are going to change going forward, I think, for the yen going into 2012. It's not the same currency. Now they've got some deficits they're running. They've got a high percentage of debt to GDP, and it's my understanding that a lot of the nuclear plants in Japan have been shut down. That means they're going to have to start importing energy. This is all going to go to their bottom line. So I think we're going to see a pretty significant turnaround in the yen. Whether it's against the dollar to any significant amount, I can't be sure of that yet, but I would still target 81 or 82 on dollar yen. But I would also keep an eye on those cross pairs, like the Aussie yen, the CAD yen, New Zealand yen, maybe even Euro yen, because I think there's some opportunity there if everything goes the right way. U.S. Swiss franc, I think the Swiss National Bank is going to be sitting, waiting to intervene here. Keep a very close eye on Euro Swiss franc, because Euro Swiss franc is going to determine the likely next move on U.S. Swiss franc. Now, if we catch a bid on the dollar going in, if we get a strong ADP report number, again, the Fed committee was certainly not all in agreement as to when rates were going to be raised. The situation with interest rates in the U.S. can change very, very quickly. The situation in the Eurozone can again change very quickly. So everything that's happened this week can be completely undone by the middle or the end of next week. So the main thing is watch those key correlations that I've talked about in the presentation here today, and make sure you keep stops in your trades, because we're going to see probably a lot more very wild swings, a lot more significant swings in the market next week. So that is the Forex Weekly Outlook for the week of January the 30th, 2012. And again, my name is Greg Furman, market analyst here at TraderPlanet.com.